something that people don't really ask me about that I always bring up when they're looking at the fund is we're doing short-term trading. It's taxed at the highest rate. So tax mitigation is something to think about. That's why I build the real estate bucket in tandem with my fund position. Basic numbers here. If you do development deals or value add deals, most of them are going to give you 60 to 80 cents on the dollar of passive losses to write off against your hedge fund income, which is also considered passive. You know, if I'm going to invest 200,000, I put 100 in Kerns capital, I'm going to get this year or last year, let's say 60 grand, and I put another 100,000 in a multifamily real estate deal, I get $70,000 tax write-off. Now I keep my whole 60% tax-free.
Happy New Year. It's another wealth webinar, but this wealth webinar is special because it's 2023 now. That's right. We turned a new year. All of us are, well, not so much a year older, but we're a year wiser because 2022 taught us a lot of things. 2022 opened up what I like to call revenge summer. We got revenge for being locked up during the pandemic. We went out, we did all those things. It's going to be interesting to see how many children are born from that revenge summer, but we'll get to that one in another episode. Today, I've got some really special guests, but we're going to be talking about alternative investing. We're going to talk about how to make money when everybody else is losing money. Who wants to know that? When all your friends, your coworkers, your family, they're all bitching and moaning that they're losing money, but yet you're the only one in the room making money. Do you raise your hand and say, I'm making money? You want to know how? Or do you just stay quiet? Because I know that's a difficult one. If I was with my family, I'd zip it. I wouldn't say a word. And because none of them, they act like they want to know, but they won't do a darn thing about it. Can any of you relate? The people closest to you that you could give that advice to, you could tell them how to make money when everybody else is losing by changing just one thing or changing a couple things. And then when you tell them, they don't want to hear it, right? I know you've all tried it. I know all of you that have been around this campfire, listened to what we talk about, and gone back to your loved ones and explained it. Didn't go so well, did it? Yeah, well, that's the reason why I don't help any of my family members with this. I mean, my mother, but outside of that, you know, they all know what I do. I try to explain it to them, and it falls on deaf ears. But you know what? There is now 121 of you, and all of you want to know. So that's what we're going to deliver. But we got a special guest today. So we got Justin in the house from Kerns Capital. It's not so much that what Justin does today. It's not that we're going to just spend all the time talking about his hedge fund where they do algo trading and all sorts of sophisticated stuff, which their track history is unbelievable. And I can tell you this, when everybody's losing money, they're making it. And it's very easy to understand how, and you probably want to know how. But I think the really important thing to understand is Justin and his family, they're affluent, okay? They've done quite well. They've had a family business, which I'm sure he'll tell you about. They've sold the business. And I want you to know one thing. He doesn't put his money, and his family doesn't put their money where most of you are being told to put your assets. They're not putting their money in 401ks and stocks and those index funds, which are so good, because I promised I'd talk about the average rate of return today. He looks at things completely different. Actually, he looks at things a lot like many of you do. And that's exactly what I want to do. But I want to turn it over and I want to have Justin tell the story himself, because I can tell it from how I heard it from third person, but he's going to be able to tell it a lot better. So Justin, welcome to Wealth Webinar.
This is great. I'm happy to be here. Are we starting with the story of how we lost everything first?
I think that's the only way to start it. Because, like, listen, let's ask the audience. How many of you want to know how him and his family, how much was that company worth that your dad had?
Oh, I mean, at the time, this was in the late 90s. So I believe around 50 million, but then it got sold again over 100 million.
Yeah. So how would you like it if you had, or your father or your family had a business worth $100 million and then all of a sudden it was gone? That would suck, right? You guys want to hear that story, or should we just skip that boring story and go right into the good stuff? All right. Yeah, they want to hear it.
Yeah, it's important, right? Because this is what shapes you as a person. And I was pretty young. I was 13 years old and my dad lost everything. And going through that experience of having a very privileged childhood to lose everything overnight was something that at the time was catastrophic. But for me, looking back on it, it's the reason why I am the way I am, the way I need to protect money, the way that I make sure this kind of thing will never happen to my family. going through that was interesting. I learned that money is so important. Lack of money will tear a family apart. My dad sold that business. He didn't have a plan for the money. He didn't know what he was going to do next, didn't have a plan for it, ended up putting it all in one place and got Ponzi schemed, lost all of it, right? So within a year of that, I mean, my mom and him, disaster, divorced within a year. I'm the oldest of 4 kids, and it got real ugly, restraining orders. My mom suing him for money he doesn't have. Like, it got so awful, and I got to see how a family can unravel because of lack of money. And that's why I just got so passionate about this topic. So fast forward, my dad's an incredible entrepreneur. When I was 16 years old, he started Heartland Foods. With a little bit of the money he had left, he bought a failing food service for $200,000. That's what he purchased the business for. It was like 2 trucks, a customer list, and maybe 1 or 2 employees. You know, money wasn't what it was at that point. So I wasn't going to go to some fancy school or anything like that. I went to a little state school in Baltimore, right next to our corporate headquarters at the time. It was really small, doing less than $1 million in sales. I was packing orders in the warehouse, learning the business. Then I was doing deliveries when I wasn't in my classes. And then in between my junior and senior year, there was nothing for me in college. I was like, why am I even here? I knew I wasn't going to find my path that way. So I went into sales at the company. And by the end of the summer, I just wasn't going back to college. So I dropped out, went all in on sales. And I took over that side of the business. So I built our sales team. We grew the company to over $10 million in sales. And then what happened was a pandemic, which if you're a food delivery service, it's the greatest thing that could ever happen to you. Everybody was in the market for what we did. The company exploded. And then that's when the private equity companies were knocking on the door. The plan the whole time was, this is our family business. My dad was going to hand it over to me. And that changed really quickly. So we made the decision, we sold it. And I'm still on board for a transition period right now. You know, we had a plan for the money this time. And all of that research and obsession that I had when I didn't have any money is why I knew what to do with the money when we got it. So I've been investing heavily in commercial real estate. We can talk about why that's so important from a tax perspective. It's not the sexiest returns. And then the hedge fund is really where, you know, the bread and butter of the returns are coming from.
Well, I think the important thing, you know, and I want to ask the audience, you know, how many of you, you know, have come into a windfall of money? I don't care what it's from. Maybe an insurance settlement, maybe, you know, a lawsuit, maybe you sold a business, maybe you just got a big profit sharing bonus or something. How many of you have ever come into that? So when you come into a lump sum of money, the first thing you're probably thinking is, what do I do with this? How do I make this work? How do I turn this into an income stream? I mean, it's going to be different for everybody, but everybody's going to have a different need for it. And a lot of times that money that's there, especially if it's newfound money, and Justin, I want you to kind of talk about this, you know, there's this like sense of urgency to get that money somewhere. It's almost like, oh my God, I got it. And now I need to get it somewhere. I need to put it somewhere. I need to figure this out really quick. And a lot of times that decision leads to an emotional based investment decision. Many people, when they get a lump sum of money, listen, when I was an advisor for 16 years, I swear to God, like a dog sniffs out food, I could sniff out when somebody got a lump sum of money. I was like, you just got, and that was it. And I bet you the financial advisors, many of you that receive money are dealing with that too, right? They come up with these elaborate plans on their Morningstar reports showing you all this fancy stuff that you have no freaking clue what you're looking at. You're just like, wow, it's pretty. It's got orange, it's got blue, it's red, and some numbers, and green is good, red is bad, I guess. And well, great. What exactly is this thing? And the advisor tries to explain it. You're still saying, I have no idea. And then you're just like, you just figure it out. It's the worst thing you can possibly do. But that isn't what Justin did. And that isn't what any of you should do when you come into a lump sum of money, because the best thing to do is just pause. And I would say right now, a really good thing to do is just sit back, look at different things. There's lots of options out there. Alternative investments, like what Justin is going to talk about, and what, you know, the real estate space would be, are great things to look at. I mean, the infinite banking concept, me and Justin are talking about that. I mean, what better place to store your capital than a giant mutually owned insurance company that pays dividends? I mean, there isn't much better than that. But I think the thing you really got to do is just understand this year could hold some of the biggest opportunities of your life, but we don't know when they're going to be here. I think now is a little early. And Justin, do you agree? Like, it's still a bit early?
Yeah.
Some levels. In the future, like 3 months, 5 months, 6 months, there might be massive opportunities, but you got to decide what it is you know, like, and understand. So Justin, like, how did you make the decision when you got this big windfall money and like you wanted to do it? Like, how did you land in creating, commercial real estate? I'd like to talk about a little bit more, like what was intriguing about that, but then a hedge fund, like an algo hedge fund for that. Most people don't even really know what that is. So let's explain that to the audience. And let's just talk about how your decisions, landed you where you are now.
Yeah. So I learned, and I guess I'm very observant at what I don't want first. And I watched my grandparents go through, very modest life, save just enough in retirement. And, the markets crash every 10 years or so. And if you're in a traditional bond stock portfolio, in retirement, you need to draw down the money. And I watched what happened to my grandparents in 2008. If your nest egg gets cut in half, how can you draw down from that, right? So you're always living in this state of fear of the principal balance. How much can I take? Where can I live with? And I just didn't want that for myself. So I just started reading a ton. And what I came to understand was that the wealthiest people have indestructible cash flow. That's really what they're concerned with, is how much mailbox money is showing up every month, regardless of what market conditions are. This is what gets rid of financial fear, is when you have a reliable, heavy stream of incomes that's coming in every month from all these different sources. So that's why I started looking at real estate. It's easy to understand. I made the mistake a lot of real estate investors do. First, I started with one unit, not a good idea. And then I realized I could go into syndications, these much bigger value add projects where I might only own 1% of that project, but I'd rather own 1% of something massive than 100% of something small. So that's how we got into the real estate. And the tax benefits from real estate are just incredible. So if you sell a company and you've got a multi-million-dollar tax bill like we did, you can reduce that tax bill to zero just by investing in value add development deals. There's always an answer to these things. You just have to be connected and know how to do it. So when I knew we were going to be selling the company, I was like, what am I going to do next? So I started going to a ton of high-end masterminds, and this is a great lesson. Proximity is the best investment you can ever make. Spending money to get next to the people or near the people, talk to the people who are doing the things you want to do that have a lot more success than you. That's the ultimate shortcut in success. So that's what I did. I just started going to events, buying the highest level tickets, seeing what I could learn, what people are doing, where are things trending. And that's where I met my now business partner. He was launching this hedge fund. He had been testing an algorithm for 2 years. It hadn't lost money in a single month. I just knew. I'd done some business with him before, some marketing stuff. He was a Heartland customer of mine. We had already done some business. So, I knew how he operated, and we were kind of feeling each other out because, at a high level, if you're going to go into business with somebody, like, the relationship is everything. So I just knew that he was the guy. Total visionary. He's only 28 years old. His name's Cody Kerns. If you want to go check him out on Instagram, he's got a ridiculous following on there. I just started bringing him value. This is another good lesson. I didn't say, hey, Cody, I want to be in business with you. I just went out and hit the phones right away and started raising money for him. Didn't ask for anything. And after I brought in $300,000-$400,000 in the first week, he was like, hey, like, can you keep doing this? Like, absolutely. And now I'm a managing partner of his fund. So it's the food chain thing is really important. You need to lift up people beneath you, but you need to bring value to the people above you. Don't ask them for anything.
I think one of the important things in Cody Kerns, 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 Kevin. One of the things that I love that you said is, you mentioned that you found something that really intrigued you, that you really liked, that could benefit and solve problems for you. And then instantly you just went out and started helping solve other people's problems by introducing them to them. And because of that, you didn't do that saying, oh, I think if I go out and I raise money for him, I bet you he'll want me to be the managing partner of his fund. You just did it because it was the right thing to do. And so, that is just a golden rule. You give, you get, right? It's been said by, some of the greatest out there. And if you help enough people get what they want, you will get what you want. And that's what you did. And I think there's an important lesson and takeaway in that as well. So how did that discussion go? You raised like $300,000-$400,000, which in the hedge fund world isn't really a lot of money, but it piqued interest. You did it in like a week. And then what happened next with that? And then also I want to take a step back. because so far we've just said it's a hedge fund and it's an algo hedge fund, which to most folks on here, maybe they know what a hedge fund is, but algo something, algorithm. But I want to really dissect what the fund does and why it's very different and why it's really, really positioned for what's going to be what's happening right now in the markets, but also what's going to be happening moving forward. And then we'll kind of dive into some other things. And I want to get Stephen to kind of come in with you, because me and you have already talked about the infinite banking concept. You saw me present it at the mastermind. Again, proximity is power. You instantly are like, wait a second, this is really cool. So I want to have Stephen talk to you a little bit about that, because we've already spoke. So another person's take on it. And then we'll just keep going and diving in.
Yeah, so the algorithm, our hedge fund is in the currencies and commodities space. So you can use algorithms really in any space, but the reason why we play in this space is it's the most liquid market in the world. We're talking $6 trillion is traded in currencies every day. It's the easiest way to arbitrage with an algorithm. And it's a very new space. It's not as new as crypto, but when we look at how long things have been around, the currency space as we know it now didn't really exist until they launched it in, I believe, 1972, because before that, it was just currencies to commodities. It wasn't currency to currency. And that coming off the gold standard is really what started the currency trading space. So it's relatively new. The huge institutions don't really play in it. And that's why there's such an opportunity for a smaller hedge fund like us to really, really penetrate the space. So what it does, it just high frequency trades, looks across all the order books. It can get small little arbitrages. It has a 1% max drawdown, and we try to get 1% per day. And at the end of the month, after all the fees and splits, to make it really simple, we've always returned somewhere between 3 and 7% to the investors, net of everything, on a monthly basis. The distributions are quarterly, but that's what you can kind of expect is a 3 to 6% monthly return. Very stable. Never had a losing month. The worst month on record was 3.88%.
That's your worst month.
Worst month.
Sucks. And folks, that's not an annualized return. That's a monthly return. And it's kind of funny because a lot of people hear returns like this and they're like, oh my God, that sounds insane. Well, this is stuff the wealthy have been doing for a long time. They know about things like this. Now, this is not available to everyone. There's some rules to getting into this. You got to be accredited. You guys know the routine. You can Google what is an accredited investor. And I'll tell you, most of you on here, because I'm looking at the names, most of you are accredited. It's self-verifying too, right? They verify they're an accredited.
Self-verifying. Yeah. We don't do the third party investor verify like a lot of the real estate funds do.
Yeah. So, the way that they do things is why it's so stable. And also, what do you foresee? So that's good and great that we're talking about it now and your worst month is 3.88, but what do you foresee as the markets deteriorate, as we go deeper and deeper into the recession, maybe even turning out to be, the next Great Depression? Because there's a lot of really, really smart economists and smart people out there saying that's what's going to happen. How will this factor into that? Or will it have any impact on what you do?
I think last year was a perfect example of why I sleep like a baby every night and everybody else is terrified. This is non-market correlated. As long as people are moving currencies in and out, we have a market. And it has nothing to do with stocks, bonds, any of that. They could be going through the roof. They could be crashing. It doesn't affect what we do. Every single day, that money goes in, it trades, it comes out. We're talking 3-second to a minute trades. It's liquid every day. So there's no market risk in that sense.
Can you just say that beautiful, sweet word again that you just mentioned there?
No market risk.
And the second most beautiful word was liquid every day.
There you go.
I remember when we talked about it at the thing, because you were explaining it to me, and I might have a higher level of understanding on what this is, but my first thing I said to you, I said, all right, what's the liquidity? Because my number one thing right now is I'm trying to maintain liquidity because I know the opportunities that are coming, but I still want money to work for me. I don't want to just leave it sitting, especially in bank accounts, but most of my money is in my private banking policies, but I still don't want to just leave it there because lazy money that just sits isn't working for me. So I was looking, all right, well, what are short-term opportunities? And private money clubs have been my only source for finding short-term lending opportunities. And I've done very well there. But then when you talked about this and I was like, so what's liquidity? I'm thinking you're going to say 5 years or 3 years. And I'm like, that's just not going to work. What did you tell me?
We have a 3-month lockup. That's it.
How about that?
We want to differentiate from everything else that's out there. And if you're really confident in your strategy, why do you need a 1-year lock? Nobody's going to want to take money out once they get in. So 3-month lock, that's it. And you can take distributions quarterly after the 3-month lock. If you want all your money back, get it back.
Absolutely. And real quick, just for the protection of this show, I just want to do a quick disclaimer. We're not making any recommendations, not making any suggestions. No investment advice is being given out here. We're just talking about Justin, his story, what him and his family did and why he went this route and what he's doing today with this hedge fund. So I just want to be clear about that, and when we're talking about also, I want to be clear, like if any of you end up working with Justin with the hedge fund, investing money with Justin, we get nothing. Okay, nothing at all. And I want to be very transparent. Actually, we can't get paid because the way the fund's set up, only the partners are the ones that can talk about it and do that. So I just wanted to be transparent. So now the disclaimer's over. Let's get back into the fun stuff. Well, let's segue real quick. And I want to ask everybody that's on here, what questions do you all have in regards to what we're talking about here? So you all understand currency, right? We here in the United States, we use the US dollar. But there's also, there's the yen, there's the ruble, there's all sorts. Which currencies do you mostly focus on?
It's interesting. It's not really one pairing. It's whatever the algorithm sees. So some of these trades will be commodities to currencies. There's been a lot of gold to the US dollar trades lately. There's been a lot of British pound to gold, stuff like that. And then, currency to currency as well. So it's a big variation. I'm not the technical person behind how the algorithm executes. So,
but I think it's pretty easy for most people here listening. I mean, sometimes you get into like really high level stuff, but I mean, you all understand currency, right? You understand, you've traveled, different parts of the world and, you use their currency when you're there. So you each understand that each currency has a different valuation. Those valuations fluctuate at a high level. The US dollar to the euro fluctuates. They all fluctuate, US to gold. So you understand that. That's the cool thing. Because remember what we said, one of the laws of wealth is only invest in things that you know, like, and understand. So as long as you understand that there's different currencies, they all have different valuations, and every single day, heck, even more than that, every second of every day, there's different fluctuations in that. And they've written a computer program, essentially an algorithm that just captures those inefficiencies, those little movements. Okay. And they just every 3 seconds, I think you said sometimes, whatever it is, every 30 seconds, it just picks up like nickels and dimes. And I love that because Stephen and I, that's exactly what we do every day. With the infinite banking policies we don't get paid a lot because we give up 60 to 90% of our commission so that our clients have that. But what we've gotten really good at doing is kind of like what the algorithm does. We see a penny here, we pick up a nickel there, we pick up a dime there, and everybody's winning. And that's kind of what you guys are doing. So your investors are winning because you guys are becoming masters at picking up pennies, nickels, and dimes. And I love that.
By the way, I saw something in the chat. My full name's not up there, but somebody got it in there. Yeah, it's Justin Freistadt, which is impossible to spell. So good luck.
And the best place to find him, Instagram. He posts a lot on Instagram, YouTube, I believe, as well. Correct? Or where's
I just started a YouTube channel like less than a month ago, but yeah, Facebook and Instagram are the two heaviest.
Awesome. Justin, when we were in Destin, I remember everybody, it was really cool. Like good masterminds, one thing you'll find is everybody has a chance to stand up and say what they do. And he stood up and he said he's a manager of a hedge fund. My ears perked up. I think I was in the back probably drinking coffee and my ears perked up. There's someone who's got a hedge fund. Where is he? And I think during my entire talk, I picked on you the whole time because I didn't know, hedge fund. I didn't know what it was, but I'm just assuming, yeah, this guy's a Wall Street guy. So I'm just going to talk to him like that. After we got done with the talk, we started talking about the hedge fund. We started talking about lots of different things, but we also talked about what it is we do with the infinite banking concept. So where was the attraction to like that piece? What was the first thing that caught your attention there?
Yeah, it's something that's been on my radar for a long time. Other people have told me about it. They couldn't really get me there, fully understanding it, which you were able to do because you're so well versed in this. And what I realized was that no matter what you want to do with your money, it's an initial step, right? The money should go into this policy first, and then you can borrow it back and then go do whatever you were going to do with it anyways, and then keep a small spread from the dividend to the cost to pull it out. So it just makes sense to add another layer of investment, the death benefit, all these other things that come with it, asset protection, So it just is a no-brainer. So what I'm planning on doing is restructuring a little bit, probably take a big distribution next quarter out of the fund and put it into the life insurance policy first. Then I'll borrow from it and put it back in the fund. And now I'm double dipping.
Stephen, what do you have to say about that? How many times have we heard that, right? People, they have money in something, maybe it's a business or stocks, and they take the money out, they run it through the policy, get it approved. Then when the money is approved in the policy, take it and put it right back to the original place it was. And now they're making money twice.
Yeah, 100%. I mean, that's what it's all about, is just get it in there, start that uninterrupted compounding, guaranteed tax-free growth for the rest of your life, and pull it out and grow your wealth just the way you would anyway. So it's a beautiful thing.
And I was just doing some simple math here, and correct me if I'm wrong, Justin, but 3.88 was your worst month, right?
Yep.
So I always like to shoot low. So I just did 3.88 times 12. That's 46.56% on an annualized return. So all we ever talk about with what we do with being your own bank is spread. Okay, we just talk about a spread. So if I just play that, I just found out One America's loan interest rate on the loans that they issue on the policies is about 4.8. So let's subtract 4.08 and forget about what the policy's earning. But we're just going to do this just from the pure spread. That means your net is 42.48%. That's one spread. But then that also didn't account for how much money you're making in the policy each year, which in the first 2 years or 1 or 2 years, depending on how your plan's designed, it's usually going to be a loss. So I don't think anyone would care about 2 years if they were making that kind of a spread on this side. And then after that, now all of a sudden, now the spread is twofold, because now you're making money, just like I showed that on the worst month. And then also over on the policy, now that thing's just starting to really make some good returns. Stephen, do you have any other returns that we could show on some of the policies we do? Right at your
Pull up an illustration.
I just think this would be fun just to look at this, because I mean, this is a whole different level, folks. I mean, yeah, Michelle, it's kind of a no-brainer, right? So a lot of you, and we always have to be careful, that sounds too good to be true. And Jill, we're going to get into minimum investments, and I love these questions, folks. Keep the questions coming. You guys are so well trained in this. Look at it. I didn't even have to ask, and you guys are throwing all the questions over in the Q&A. Holy cow. That's awesome. Keep them coming. Put them in the Q&A. We would not miss one question, but I just think this is really fun because we don't get a chance to do these webinars a lot where we actually can talk about real things like this. A lot of times it's strategy, it's conceptual, but heck, you're the manager of this fund. You can talk about the returns, so we can actually get down to the nitty gritty and just look at what would this look like for any of you that have a policy or someone that starts a policy. And that, and a bunch of you, when you said you had windfalls of money, like, well, what if you just did what Justin said? You took the windfall, you just dump it into the policy and then take it back out and, do something like what Justin's doing with the fund. I mean, once he pulls these numbers up, we'll be able to look at some really cool things here.
So these are bigger numbers, but this is a policy that was just approved that I was just looking at this morning. So I figured I'd just pull it right up. So this one was one that we put $500,000 in the first year and then 60,000 a year after that for 7 years, and then drops down to 54,000 for a few years just because of MEC rules and limitations. Once we get to that 7th, 8th year, we could probably get more into it at that point, but right now in this initial one, and then you can see it drops down to 24,000 a year after that. But just right off the bat, we put the 500 in, we could take 466,000 right back out. And then check this out, starting the second year, every dollar they put into this thing, they're pulling well more than $1 back out. So in the second year, they dump 60 grand in, and then they can immediately pull back out about 66,000 of that. And you can see just as time goes on. So, something fun that's kind of do is, okay, you got to put your money somewhere, right? So if we were just to keep putting our money into a bank, and then let's say in the 7th year of this thing, we decide to do an investment with Justin, right? We pull the money from our bank. Now we're making the 49, 59% with Justin. That's great, but that's all we're doing. But what if we would have done that with our policy money in the 7th year while we're getting this growth at the same time that we're making the 49 and 59% with Justin? And that's what we really want to look at, right? Yeah, not to mention the legacy planning of the death benefit as well.
So folks, just how I always do it, just look at the second year. Stephen, if you can just put the cursor underneath the increase in net cash value year 2 on this one. So, year 2, he puts in 60. and he's got 66,465 in there for this example, right? And a large reason why this policy is so rich by year 2 is it's a healthy dump in. He's got $500,000 he dumped in, but that's what we're kind of talking about here, right? You get a windfall money, you dump the money in. This, if I'm not mistaken, this particular client sold a piece of real estate and had the money, or took I don't know if he sold it or took the equity out. Stephen would know, but he had 500 grand, like, and it was just lazy money. So he dumps it in the policy. The first year you can see, like, that sucks. Puts 500 in, only has 466, 359 in there. You know, if we were to show this number on Instagram or TikTok, you know, all the haters would come out like they did this morning and be like, well, why aren't you just putting your money in the S&P 500? Well, because you'd be down 20%, but anyway, we won't go there. But the second year for this particular plan is what we call the efficiency point. Put 60 in, has 66,465. So here's how I do the math. I do it just like any real estate investor would. I take the 66,465 and I subtract the premium, because you don't want to, you know, that the premium is new money's going in. So I subtract that out. That means you made 6,465. Then I just divide that into the $60,000 that I put in there, because I'm looking for the cash on cash return. So for everything we do and everything we're talking about with Justin, this is really the only thing that matters is cash on cash return. The new monies you put into the policy, how much money are you making on that new money? And a lot of people want to play the old game because it's just the way we're trained. They're like, wait a second, Chris, you put 560 in and the total cash value is only 532. The dude's still losing money. Like, how are you saying he's making money? He's not losing money, because if he put 500 in and he took 466, 359, and then he put it into the hedge fund, let's just say he did that. That 466, 359 is working for him. That money is no longer part of the equation for the math we're doing. That's right. It's a 10.78% cash on cash return. So the second year, the third year, fourth year, all we really want to know is any new monies we put in, what's the return on the new money? Because that's how we're going to figure the spread year by year, right? Because that's all we care about. Each year, we're assuming you're going to put money in the policy and you're going to take that money out and you're going to make it go to work somewhere, paying off debt, buying cars, putting it into a hedge fund. But you can see here, if you had 10.78% cash on cash return, the loan rate for this company, I think, is 5%. So subtract 5 from that. So we got that minus 0.05. That brings you down to 5.775 net return. Now I want to, so just so you understand, because we only use numbers that are net. Okay. Net means for all those people that are like, oh, whole life has that really expensive death benefit. Net means net of cost of insurance. Net means net of policy service fees. So these numbers you're looking at already have the cost taken out for $8.5 million in death benefit. It's already out. So should this client ever pass away, his wife, and she's awesome, she, you know, they run their business together, awesome, gets $8.5 million. Now, I know we don't focus on the death benefit, but you know what? You all want to focus on the death benefit should you get sick or should somebody pass away. That's the only number you're going to care. You're not going to care what the cash value is if you lose your significant other or your loved one, right? You're going to be like, well, how much was the death benefit? Wait a second. Did you just say 8.5 million? I was excited about the 500 in cash value, and you're saying there's 8.5 million in death benefit. So again, like, we don't talk about it, but it's so vitally important because it provides that protection for your family and that legacy that you talk about. But back to the numbers right there, you're making 5.78%, but we already netted out the cost, right? 5.78 is subtracting the amount the insurance company charges us in loan interest for borrowing our death benefit. So now we take 5.78. Okay, which by some of you is like, well, that's not a bad return. Like, that's lazy money. That's guaranteed money. Like, that's not bad. But Justin, what did I say that number was for yours? Hold on, let me do it again. 3.88.
Well, I'll tell you what it was this year. I mean, we don't have our December audit done yet, but it's looking like we came in at 59%. Okay,
59%. Now, this is kind of a silly kind of one to use because that's just a crazy number. But if you did the investment with Justin just with money from a bank account, you wouldn't be upset. But how many of you, if you did the money, if you just changed where the money went first, and then you just put it into the policy, you just literally added a tailwind of 5.78, and we're only in second year. If we play this game and we go to year 2, 3, 4, 5, like the number just goes up. And that isn't because you did anything different. It's just mathematics. It's compound interest. So like, this is where, man, I get so freaking excited about this shit. And I get so mad at people when they play the short game, they play the year one game. Well, I don't know. Or we get the call at the end of the year and they're like, well, I put this money in and this isn't what it was supposed to be. It's always what it's supposed to be. There isn't one client that we have that the number is different than the number we showed them. Thank God, knock on wood. Dividends have maintained. Actually, Stephen, so what would you say about this? Like, that's crazy, 59%.
Yeah, no, I mean, it's 59% plus the 5.78%. And Justin, you could do this in an IRA, a self-directed IRA, you can invest with you.
Absolutely.
Yes, I mean, you do that in a Roth. I mean, you got tax-free growth on this and this. And keep in mind, this is, for life over here, the policy. So the early years, it's exciting. You're building something. It's not that exciting, but let's do that same example maybe in year 9. Is that fair?
Yeah, let's do it. Yeah, let's do it.
Because again, your money has to go somewhere. So you're either putting it in someone else's bank or you're putting it into this policy that's acting as your bank. So you can decide, you guys decide. So let's look at year 9. So same thing, we'll look at year 9. So what's year 9 growth, Chris?
95, 790 or 769. I need glasses.
95, 769.
The premium, which is 54,288. Net return in year 9 is $41,481. So like, folks, just to put this into perspective, I want you to really listen to this because this is kind of like when Justin said 59%, you're like, that sounds too good to be true. But let's just look at year 9. You put $54,000 into your policy in the 9th year. You then go back to the insurance company and the insurance company says, you ask how much money you could take out. Well, you could take all of it, but the gain is 41,000. So what is the return on that? You put 54 in and you take 41 out, just gain. I don't even know. What does that work out to be? 76%?
76.4%.
Eat your heart out, Justin. Eat your heart out.
Oh, but Chris, I gotta pay the insurance company to use my own money.
I know, and Lafayette charges a lot for that loan interest rate. I think, aren't they like 5% or heck, didn't it just go up? Oh my God, it just went up to something, I think. Like 5.25% or something.
Tax-free.
Yeah, 5.7. Craig just nailed it. Like they just raised it to 5.7. Oh my God, that sucks.
5.7.
That sucks. Why would anyone do that? So come on, fix the number there, man. It's 5.7. Let's get real here. I mean, see, that just destroyed your return, man. That just killed your return.
That's not the best, but something around that.
Oh, man, that sucks.
All right, so we're at a 70%. Okay, now let's take that money and let's invest that with Justin. Justin, what are you guys going to do in this year, you think? Never mind, don't speculate. We'll use last year. 59%.
I'll tell you the target is 30 to 60, and we hit basically the top last year. So a terrible year would be 30%.
59 plus 7.7. So let's see. How do you feel about 129% return on your money?
That's great.
Feels normal once you're in this game.
Yeah,
Right?
and that is
How the wealthy get wealthier, right?
It does
Yeah.
feel normal when you're doing this. This is just kind of like, this is just business as usual. But for outsiders looking in, that's too good to be true. That must be a scam. Okay, if it's a scam, then why don't you just call Lafayette Life and just ask them and show them these numbers. We'll give these to you. We'll just get rid of the name on the top, or we'll do one for you. Like, and then just run this by them and just say, hey, is this a scam? And they're going to look at it and be like, what's that say on the bottom there? Doesn't that say Lafayette Life? Yeah, that's our illustration. So that's exactly what the numbers are going to be. So it's just, sometimes I'm just baffled as why people look at this and then they find reasons to not do the application call. It baffles me. Like, they're super excited. We get them on the phone. They're pumped to do this. And then they never take the application call, or they get on the phone with the application call and they say, I changed my mind. I don't want to do this. I guess there's circumstantial things that could happen, but like, where does this not make sense? I mean, please help me. I mean, is there any reason this wouldn't make sense for just about anybody? I mean, even if you didn't have the dump in, sure, it's not going to look as good because we don't have all that interest, but still going to be darn good. And it doesn't matter. I mean, that is almost unbelievably good. And even if it was just half of that, everybody would be laughing and running around talking about it. So folks, I just wanted to do this because like, this is real. Like, we're not using hypothetical numbers right now. We're using real numbers. We're not using average rates of return. There's no average here. I did the math for you. You guys can all do the same math. Heck, I mean, let's humor everybody. Let's just do the cumulative return. I got to do this. This is going to take me a second.
And Chris, while you're doing that, let me just hit one question here. So somebody was just asking, why the death benefit falls a little bit in year 8 right here. So the death benefit is good to talk about. I mean, like you said, it's not why we do this, but this is how you create a legacy. This is how you start using trusts, complex trusts. to really build something for the future for your family. But this drops right here, because when we build these policies, real high cash value like this, we have to operate within something called the MEC rules and regulations that the IRS sets, and it regulates the growth and what these things can do. So when we build one of these policies for real high cash value like this, sometimes we have to sparkle in a little bit of term insurance to avoid the MEC of the policy. And so when we do that, we just purchase the smallest amount of term insurance required to sneak us in right underneath that MEC limit. And then as soon as we don't need that anymore, we drop that term off of the policy, because the term insurance has no added benefit for the banking features of this policy other than to avoid MEC. It's pure cost, essentially. But cost is only an issue in the absence of value. So adding the cost on there for a few years gives us the value of building this very high cash value and getting you access to all this money so early on like this. So it definitely needs to be on there, but that's why that drops, is as soon as we can drop the term, we do get it off there. So the death benefit, but then you can see how it starts growing again from there. I mean, again, this is an approved policy that this young guy, he's 33 years old, is putting in place this week. So again, it's not a hypothetical. This is an actual legitimate policy, and Justin's telling you actual legitimate numbers that his hedge fund did just this past year. And this is what it's all about. I mean, this is once you start learning about controlling your money, what do you do with it? Like, where do you go? And that's when you start learning about private equity and these types of hedge funds and algorithms and all the stuff that Jim Cramer would freak out if everybody knew about, because why would they listen to him give bad stock advice every day, right?
Okay, so this is interesting, and I rarely do the math this way because it's just not what we teach, but I do get this question, and I wanted to address this, and then we're going to hit all your questions, folks. But so what I just did is, in that illustration, and I wrote the numbers, so I'll just kind of walk you through it. I went to year 9. Now, you saw the cash on cash return, which you all liked, but there are still some of you that were looking at it being like, no, you're just adding up all the premiums, which if you did that for 9 years, 500 was the dump in, 240 was the 60,000 times the number of years, and 108, 760 or 576 was the whatever, 50 some thousand. Comes up your total premium put into the policy, 848,576. Now, Dave Ramsey would say that's expensive whole life. That just costs so much money. Look at how much that life insurance costs. No, hold on, Dave. This is how much cash value you had in year 9. So let's just pretend that you never listened to me and Steven. You shunned off Justin and said, that hedge fund thing is a scam. And you just did nothing. You just put the money in the policy and you just let it sit and grow. And if that's what you want to do, we're probably not a good fit. But let's just pretend that's what you did. You'd have 1.15, just a bit over $1 million, okay? 1,115,388. So now we take that number and let's subtract out that premium. We put 848,576. So your net profit on that policy was $266,812. Now, depending on how you do many of you would do your 401k return and you'd be like, wow, since the beginning, I made 31.4% return. And that's not terrible, right? It's nowhere near as good as the cash on cash. This is just the person that doesn't listen to us. So I'm just saying, this is like the naysayer. 31.4 over 9 years is what they made. So if we divide that by 9, they made 3.49% every year. 3.49% is what they made every single year. Now, some of you don't like or don't think that's a good return. So please tell me, where else can you put your money? Anywhere. And if somebody's got a better answer, I am going to change all my presentations. We will literally not do webinars for a couple of weeks and we will use your vehicle. But where can I put my money where I can earn 3.49% every year by the average over a 9-year span? And where that number really never changes, like the bank can't just say, hey, they lowered interest rates, we're going to take that 3.49 and take it to 0, like all of you witnessed during the pandemic, okay? Like this number is going to stay the same. And if I die, sorry, I missed one. Shit, Justin, I almost forgot the one that you'd love. Tax-free. So what, for Justin, like, I don't know your income tax rate, and I don't know many of the folks here's income tax rate, but what is 3.49? What is the tax equivalent yield of that? It would probably be 6. For you, it might even be like 7 because you're probably at the top tier. Well, you got your real estate, but forget about that. Like if you didn't have the real estate write-offs, I don't know, what would that be?
Top bracket, 37%, something like that.
There you go. So I'm not going to do the math, but it'd probably be, let's just say 6% is what he'd have to make in the stock market Okay, or in this high yielding thing that you all know about that I don't know about yet, about 6%. Because remember, this is tax free and you're not going to be able to be tax free anywhere else. But not only that, even if you had somewhere that could do that, when you die, is it going to pay out whatever that was at year 9, 6, or $5 million to your family tax free? I mean, does anyone have a better place? I mean, this is as bad as it gets. Because now I'm just assuming I never take the money and put it into Justin's fund. I never take any of this money year by year and lend it out through private money club. I never do anything. I'm just lazy. I just put the money in the stupid policy and I bitch about it every single year. Why did I do this? But you keep it because your wife says, sweetie, or your husband, sweetie or honey, if you cancel that life insurance policy, we're done. So you keep the policy just for the death benefit. But like, those are the real numbers. I don't know. I just can't understand why that doesn't make sense. All right, hold on. We got one here. JP, does the life insurance policy, trust, and things like Roth IRAs all interconnect? The Roth IRA does not, but the trust and the life insurance certainly can. The trust could own the life insurance if you wanted to go that route. Like that would be for ultimate protection or some tax planning with like the complex trust structures like Wealth Builders Group does. So yeah, but the Roth IRA is kind of off in left field. Now the Roth IRA plays a piece. Because you could do a self-directed Roth IRA, then you could take the self-directed Roth IRA and you could self-direct it to Justin's fund, and then you could get those returns, and that money goes back into the Roth IRA, and then it's all tax-free. That's sweet, but the Roth IRA doesn't let you use the money every single year to go enjoy, to live your life, because it's a qualified plan. There's rules. The policy, there ain't no rules. You don't even need to report it every year. When someone says, how much money do you have? And if you don't want to tell them about the life insurance, you don't have to. Private. Why is it that you don't know how much the Rockefeller's net worth is or the Rothschild's net worth? Their money's in privatized banking policies, folks. You don't know how much the Rothschilds are worth. They're probably worth trillions of dollars, and you'll never know because they don't have to report any of their income. So that's how I would answer that. But let's go to the top. Justin, I'm going to put you on rapid fire. We got
before that, let's just start with Justin. How do people get in contact with you? And is there a minimum for your fund? Just kind of the basics real quick.
Yeah, so the minimum's 100,000, 3-month lockup. It's really not much more complication. We can get into the nitty gritty depending on everybody's individual situation. The best way to get in contact with me is definitely Instagram or justin@kerns.capital. That's my email. I'm not sure if anybody asked about this, but I think it's an important thing to talk about. Something that people don't really ask me about that I always bring up when they're looking at the fund is we're doing short-term trading. It's taxed at the highest rate. So tax mitigation is something to think about. That's why I build the real estate bucket in tandem with my fund position. Basic numbers here. If you do development deals or value add deals, most of them are going to give you 60 to 80 cents on the dollar of passive losses to write off against your hedge fund income, which is also considered passive. If I'm going to invest 200,000, I put 100 in Kerns Capital, I'm going to get this year or last year, let's say 60 grand. And I put another 100,000 in a multifamily real estate deal, I get $70,000 tax write-off. Now I keep my whole 60% tax-free.
That doesn't suck. I like that.
Yeah, like a lot of people in the fund, I just refer them. I'm really well connected in the real estate space. There's always the deal. I just helped somebody place 60 million in a 1031. So if you got a tax problem, let me know.
Let's see. Chris G is asking, what was the date of inception for the fund?
July 1st. Last year, that's when we opened up the fund to outside investors. But the algorithm has a 2-year track record of testing before launching the fund.
And the nice thing is you can get in and get out within 3 months. I mean, that's kind of how I looked at it. I'm like, well, 3 months. I mean, hey, even if it sucks, it can't suck that bad. I mean, so that's a great way. But chances are you're probably not going to just jump in and be like, this sucks and get out. You're probably going to be like, I am home. You've arrived.
Yeah, I mean, it's the kind of thing where you can let it grow and compound. Those returns I've been giving, that number does not account for compounding if you leave the money in there. I kind of use it as a cash flow engine. I know for every 100,000 I put in there, I'm going to get $5,000 a month ish. So it's like if I want to, like my wife just wanted an X5M. I've fully financed it. I don't put any cash into assets that don't make me money, right? The payment on that's like $1,400 a month. But the 100,000 that I would have paid cash for the car is making me 5,000 a month, and I'm keeping the spread, and I got a free car. So thinking in terms of cash flows is a shift for a lot of people that have been programmed in this middle class thinking, get out of debt. I want to get as much cheap debt as I can and go make a ton of money with it.
You know, it would be a wild case study that someday maybe we can do, Justin, is, when you guys get your policy set up for you and your wife, the next vehicle you buy, you do exactly that. You figure out like, what would the fund need to provide, income wise to pay for the car, but then you take that amount, that you paid cash for the car, you put it into the policy, you take the money out of the policy, you buy the car, and you do exactly what you just said, but you do it through your banking system instead of their banking system. That'd be a really wicked case study.
Yeah, that's the next level for me.
So I think you're saying, can you put the money in the fund, in the policy, take a loan, and then put the money in the hedge fund? Absolutely. That's exactly what that's what Justin's actually doing. He's going to take money that, out of the fund, out of the hedge fund, put it into the policy, then take the money out of the policy and put it back into the hedge fund. So it's kind of just like a shift. It's like, take the money out of your right pocket, put it in your left, then take it from your left and put it back in your right.
But
go ahead.
Not the way that Sam Bankman-Fried did it, where he took customer money and invested. This is his money, just to clarify.
Thanks for the clarification.
Can I say something on that real quick?
I hope.
This is really important for all of you. If you're ever looking at funds, like one thing that we do at Kerns Capital is we have a third-party admin group that audits the fund every month and sends a report to the investors. There was no checks and balances in that FTX thing. And if you got a rogue manager at the top, like that's how you lose money. So just something to think about whenever you're looking at funds.
And I didn't even understand what you were talking about, Stephen, but now I do. So like, yeah, in the way I said that, just to clarify, the money in the fund that Justin's talking about is his own money. His money is invested in the fund. Like, when people say, well, how much of your money do you have in it? How much skin in the game do you have? Like that, it's his skin in the game that he's taking out. Not, you can't touch clients' money. Holy shit, you'd go to jail. And this would be a short-lived wealth weapon.
This day and age, you got to clarify that stuff though, for sure.
No, that's a good point. It went right over my head. But then when you said that about Sam, I'm like, oh yeah, I guess that could be perceived that way. So thanks for keeping me on the straight and narrow. Might need a disclosure for that one as well. All right, Chris G. Let's see. So if your net worth is only 100,000, even if you get a $500,000 windfall, the policy amount will only allow you to put in much less, correct? Isn't the policy amount based on your net worth? Chris, it's a combination of income and net worth. So in your example there with the 500 windfall, that would count. So you'd be able to put a large amount of that in. And the way they calculate it, it's different each insurance company, but there are rules. But when you get a windfall, that definitely, usually the windfall, we can get right into the policy. Like a lot of people recently have sold real estate, because they're just worried that real estate prices are going to go down. So they're selling real estate, taking the gains, dumping that into the policies, and then just reallocating that money into other real estate deals, private loans through PMC, or now maybe Justin's hedge fund. All right, Philip, I started a whole life policy for my family of 4 2 years ago. Looks like Northwestern Mutual, I would guess, not a company that we use, but not sure if I got a good deal as there are significant overfunding fees. How do I network with you guys to review the policies and learn? I'll have Stephen put up a link and we'd be happy to review that Northwestern Mutual. I'm sorry, I know a lot about Northwestern Mutual. They're a great mutually owned insurance company that pays dividends. So from that surface, it looks like, oh my God, they would work great. But underneath, like you said, they don't like the infinite banking concept. Their loan interest rate is really, really high to inhibit people or deter people from taking loans from the policy. And yes, there are definitely going to be fees. I don't know what their fee for their paid up additions rider is to dump money in. Most of the companies we work with, it's usually around 2%. For dumping the money in. That's what the insurance company keeps. It's a P-weight load is what they call it. But as you could see, like that one that we just showed, like that was net. So all those fees are out. So again, Stephen mentioned earlier, I'm going to reiterate it. Cost is only an issue in the absence of value. So Philip, just, Stephen will put his link up. Let's take a look at that policy. You probably wouldn't suggest getting rid of it. It'll make a great life insurance policy long-term, but it's certainly not going to be anything like the ones you saw us show or anything like the ones that we build, because you probably just have a standard whole life. Unanimous said, Justin, would you consider doing a smaller fund for PMC members who are smaller investors? Unanimous, come in and like, what do you mean by smaller? Like 50,000? Like what would be a smaller investment? Because that'd be interesting. And I got to be careful. I don't want to let the cat out of the bag. But let's just say that in the future, maybe not, there might be a different section in Private Money Club that has things like Kerns Capital hedge fund and, Inicio and all sorts of other stuff. I got it right. I got it
Yeah.
right. Initio, I got it. See, nailed it. Only took me 6 times, but I got it right. So we are working on some really interesting stuff. 2023, for all of you watching, you're going to hear a lot of really unbelievable things that we're doing with Private Money Club. So what you know of Private Money Club today, let's just say we're gonna put it on steroids, and we're gonna have that thing on the treadmill every single day. And pretty soon you're gonna see the outcome of what we've created. It's gonna be wild. Can you do a quick example with a lower policy and no dump in? Unanimous, we might be able to do one of those in a second, but let me get through the questions and we'll come back. I'll see if Stephen might have one with no dump in and maybe smaller. On the website, there's leverage on the fund. This has tax implications for investing in a self-directed IRA. Do you know how to answer that one? I don't know about the tax implication part, but you want to talk about the leverage part of the fund?
Yeah, so there's leverage used on the trades. So that's why the 1% stop loss is so important. If you've got 15x leverage to catch the move in your favor, that's how we create these outsized returns. Yeah, and there is an equation there. I can't remember how it was explained to me, but we could try to get 120% annual return, but it becomes riskier. So we kind of have that sweet spot where we feel like our risk is mitigated, but we can use some leverage without blowing anything up.
Yeah, that's important. So Christy, if there's something more specific, I don't fully, and Stephen, do you know what maybe they're asking? This has tax implications for investing in a self-directed IRA. I don't think it wouldn't, because Christy, and I'll answer this and I'll let Stephen do it, but like, if you're self-direct, and actually wasn't going to say this, but I know actually firsthand, if you take money from your self-directed IRA and you self-direct it into this hedge fund, the returns that the hedge fund makes are going to go back into your IRA. So the tax implications, if it's a Roth, you don't have any when you take money out. Mine is not a Roth. It is a traditional from when I had a 401k in Wall Street. But I don't pay any taxes on those gains until I start taking in income from it after 59.5. So I guess I didn't quite understand. I don't know if you were saying that because of the leverage that created tax implications, but that still wouldn't make sense. Stephen, you got anything on that?
No, I mean, you can leverage a self-directed IRA. People do it all the time in real estate with a non-recourse loan. It's you can even combine non-qualified funds with an IRA, and as long as you keep the paperwork and all the returns specifically ratioed, if it's 60-40, 50-50, whatever, as long as whatever goes in comes back out, that's all perfectly okay. But yeah, I mean, anything you invest in that fund, that would go right back, the profits would go right back in and be tax deferred or tax free. So
okay, is it ever recommended to only pay the interest back on the policy loan in order to have enough money to keep finding real estate deals? We wouldn't have enough to take out a policy loan to use it for one real estate investment property, then play honest banker to pay the monthly payment. So I kind of know what you're saying there, Brandy, 100%. So there is no right or wrong way to do this. And I'll speak from example. A lot of the loans that I take out from my policies, I do only pay the interest back on the loan because that money is going out to work. Now, if I get a windfall or money that goes into a regular bank account, I will often take that money from the regular bank and just pay down the loan balance. But doing it the way you're saying makes perfect sense. Like playing honest banker doesn't always mean, sending money out to work and then making sure that every month you're paying the loan down. Now, I do this a lot and I teach this a lot because it's how I practice. But if you had a place for that money to go to work and continue working, if it made more mathematical or economic sense to keep that money working and just pay the interest to the insurance company, believe me, the insurance company will probably send you cookies and chocolates for Christmas that you're not paying the loan back. The insurance company doesn't want the loan paid back because that's a profit center. And if you look at it's all public. If you look at any of their profit and loss statements, you'll look on there, policy loans. And if you look at the balance sheet, same, you'll see policy loans. That's a profit for these insurance companies. They don't really want the loans back because that's actually them taking money that's held in surplus for death benefits and getting that money out working, kind of like what we teach. We're always saying, get your money out working for you. Well, the insurance company is no different. They want their money working for them too. They need to hold it in surplus because they need to have money to pay for those death benefits should somebody unexpectedly pass away. But while they're doing that, if they can lend that money out at, One America 4.8% or Lafayette, I think depending on what year your policy is, 5 to 5.7, like they want that returns. And then Christy, UDFI, I almost have to Google that. It feels silly. It's my understanding that when an investment in a Roth has leverage, it triggers, unrelated business tax. I don't know who your custodian is, Christy. If it's Horizon Trust, give Brandy a call. and ask them about that. I really don't have an answer. Justin, do you know anything about that? I've never heard of that.
No, not at all.
I mean, there is all sorts of goofy nonsense that goes on with Roth IRAs because it's tax free. They're always trying to play games with them, but I've never heard about that, Christy. The best thing to do is either call I would start with your custodian and just ask them. And if you could let us know, that would be nice so that we can kind of be prepared next time if we get a question like this. But I apologize. Usually we can answer every single question and I don't know the answer to that. So you stumped me. So Stevie, is it too late for someone 71 years old to start doing this? No, you should talk to Claire Charles. She's often on here with us and she could kind of tell you, but no, if you're in good health, definitely not too late. Let's see, is this for UK people too, or just the US? So CP coming in from UK, it's kind of interesting. The video I played at the very beginning was just for you. It's literally, I made that YouTube video for all my folks in Australia, UK, Africa, and all those places that are not the US or Canada to understand that. So CP, I'm going to refer you over to that video. It's the newest video in my YouTube channel at the Chris Naugle. Here, actually, you know what? I'll do you one better. I will share you the link and that will answer your question. So CP, right there's the link for the video, and that should give you everything that you need to know about that. All right, Denise came in and said, Justin, do you have any concerns with order 14067 Biden bucks with the dollar going digital possibly this year or next? We are getting this a lot. We're getting a lot of questions about this.
I am not concerned for a number of reasons. I think implementation of that is far away from disrupting things, but we trade on the London exchange anyways to avoid regulation issues. So yeah, I don't see that being an issue. And if it is going to be an issue, our brokerage, our bank partners, our liquidity partners, it's going to be on their radar probably before mine, and we'll hear about it.
Yeah, and Justin, we get that question a lot when it comes to the banking policies. What's going to happen? You know, is it all going to be for nothing when they go digital with the dollar? I mean, the thing that everybody needs to understand, because it's kind of like getting yourself all upset over spilled milk, you know, as you maybe heard from your grandparents. But this right now is the means of exchange in this country. It's a US dollar, right? $100 bill. This is what we can use to buy gas, groceries. This is our means of exchange. This is our only means of exchange in this country. True means of exchange, you know, that's it. So we can't buy things here with, you know, you can't go into the store with that block of gold that Stephen showed in the beginning and say, hey, I'd like to buy some gold. I mean, or some bread. As much as the cashier would love to do that, like, what are they going to do? They're going to grab a chisel and chisel off a small little piece. I mean, we might get back to that someday, but for right now, this is your means of exchange. So if the Fed or the US government or the central banks or whoever ends up coming into this decides that this is no longer the means of exchange, we're now going to get rid of that and we're going to do a digital dollar. It's business as usual. Nothing changes. Okay. It's just now we have to use digital dollars, which I hate to say this, and please don't get mad at me for saying this. If the digital dollar happens, it's our fault. Because when you go to the store, do you pay with cash or do you pay with a credit card? If you pay with a credit card, a debit card, Venmo, Zelle, PayPal, you are part of the problem. I'm not saying you're the sole part of the problem, but you saw this coming because you've already been playing right into the grand scheme of the plan, because credit cards are digital in a roundabout way. So now a digital dollar just means we no longer have cash. Everything has to happen the way that all of you are paying for your goods and services anyway. You're going to use some type of a card or some type of an app to exchange. The problem with the digital dollar, from my sense, is it gives the Fed the ultimate control. So I drive a gas guzzling pig, gets about 8 miles to the gallon. Okay. And people in Washington might say, oh, that Chris Naugle guy, we're going to limit the amount he can drive that gas guzzling pig because he's bad for the environment. We hit on this earlier, Justin. He's bad for the environment. So they could literally limit how much fuel I can put. And this is conspiracy theory stuff, but like, think about it. They could limit how much money we spend. They could limit everything. If we're in trouble or something, we're going to buy a plane ticket that you could buy with cash. Okay. And all of a sudden now you got to use this, and all of a sudden your digital dollars are flagged and you can't leave the country. Well, you're stuck. If you're Tate, what's his name? Andrew Tate, that might be a problem. If you're, Sam Bankman-Fried, that's going to be a problem. But for most of us, like, they're not going to stop us from going and doing things. You're not doing anything illegal, but it does give them a lot more control. But for anybody out there that's super concerned about it, thinking it's going to change the way you live your life, thinking you're already doing it. Any of you that like ask me to pay you with Zelle or Venmo, like my word is F you. No, I won't. I'm not paying you with Zelle. I'm not paying you with Venmo. I will physically write you a check. And I just got yelled at today. Can you believe this? In Louisiana, you can't write a check higher than $2,500 and have it deposited into an escrow because I'm funding a deal. They told me that. I write checks for everything. I said, I'm not wiring money. I don't believe in wires. I hate wires. Now, I know that's a bit much, but listen, to each their own. And that's kind of how I feel about it. I mean, I don't want to be a big part of the problem, but I am too. I use my credit cards. Hell, I used the Sunoco card to fill the pig up today. It's just the world that we live in. So I went long on this, but I just wanted to do that because like, we're already doing it, folks. The digital dollar is not going to, your life isn't going to barely change. And it is coming, and they're going to force that. I almost can guarantee it. But when, I don't know.
You can cry about the way things are, or you can think about how you're going to pivot and win anyways. I mean, that's just how it is.
Let's pivot and win. Let's pivot and win. Like whatever they tell us the means of exchanges, let's find a way to make money and live a better life and solve a whole lot of people's problems. Like I want to go back to Justin's original, thing he said, how he got involved in that hedge fund. He put himself in the right places. He went to masterminds. Proximity is power. Your network is your net worth. And he found something he really liked. He found something he knew, like, and understood, and that he was interested in. And he probably did invest in the hedge fund. Actually, no, he did. He invested in the hedge fund. And then he went out and he told friends about it. He said, hey, you really need to get a hold of this Cody guy. I mean, this thing's doing great for me. And other people put money into it. And because he solved his problem, Cody's problem, Cody then came back and said, hey, not for nothing, but, and I don't know how it all transpired, but do you want to come work with me in the fund? And perfect timing, huh? Just exited my company, looking for a new opportunity. I mean, kind of works. That's how the universe works for folks. It's not magic. It's not coincidence. And it's not luck. Luck doesn't exist. Stop thinking there's this thing called luck. You know what luck is? Luck is this thing that follows opportunities. So when you have opportunities and you actually see them and you take advantage of them, that thing that happens after that, so many people want to say, oh, he just got lucky. No. That's just the after effect of opportunity. And when you understand and look at luck that way, you realize that luck really isn't luck at all. There is no lucky people. There's people that go after opportunity. There's people that go after creation. And then there's people that do the opposite and that just conform and follow everybody and do what everybody tells them to do. And well, I don't know, you ever see anyone get walked off a cliff? That's kind of the same thing that's about to happen because a lot of people, unfortunately, are forming and just going to be walked off a cliff when it comes to their money. And that's a sad, sad state of affairs. But you're all going to see it. You're going to witness it, and you're going to be happy that you're on the other side of that. And you're the creation. You're out there creating your life. You're creating your destiny, and you're creating different non-correlated, and I'm just saying that because everything we're talking about is non-correlated assets and alternative assets that you can do that nobody else is going to believe. When you talk to them at Christmas or Thanksgiving or New Year's Eve parties, people are going to call you, tell you you're crazy. That's too much risk. That's a scam. You're going to lose all your money. And then all of a sudden they lose all their money doing exactly what everybody else is doing by putting their money in normal stocks, bonds, mutual funds, and everything else. It's, hey, it's red pill or blue pill, folks. Eventually we got to realize, where we're at in the matrix. One side's pretty, but the truth, well, it's not pretty, but it's where you want to be. Justin, could you just do me another favor in the chat? Can you just put your contact information? And if you want, you can put your phone number there. Then there's a cost for that death benefit, that $8.5 million, that ain't free. There's a cost for that. And then there's a term rider on there. Yeah, there's a cost for that too. Man, this thing's starting to sound really expensive. Well, for anyone that's thinking that, when we, if you're looking at the cost, you missed the number part, right? You forgot all about when we showed you the numbers, but that's okay. But yeah, so that, wow, you did give them your number. Whoa, about to melt. So there it is, folks. He dropped the phone number.
I did figure out the UDFI,
yeah,
right?
UDFI.
So exactly like I was saying, it's if you use like a portion of your IRA and then a portion of lended funds from like a bank, like a mortgage, you have to pay taxes on that portion of it. So if it's $100,000 and 50 comes from an IRA and 50 comes from a bank, that's a 50-50 split. So 50% of those profits you pay taxes on. So exactly like we were talking about, but the other 50% going to the IRA, no taxes or deferred taxes in the IRA. So just to
So it
clarify that.
wasn't really what she was thinking it was?
No, not at all.
Thanks for finding that.
And the
Oh,
recording of this gets put on the YouTube channel,
Yep.
typically on Monday the following week. So if you just go to YouTube and type in @the Chris Naugle and just hit the little notification bell, say it, Chris.
Smash that alerts button.
You're getting good at that. Smash the alerts button, but it does help us with the YouTube channel also if you go do that, and then you won't miss any of these recordings in the future. And we got some awesome stuff lined up this year for Wealth Webinar.
Awesome. Madeline, and Justin, I'll ask you this. Is there a maximum that can be invested in the hedge fund?
Great question. No.
Some funds do. I know our funds, we put a max on them because we don't want one investor taking the entire allotment, but have at it, Madeline. Yvette said, oh, Stephen, can you just explain what an SD IRA is?
Yeah, so an SD IRA is the exact same thing as an IRA. So it's an individual retirement arrangement or a retirement account where you get tax advantages if you follow the rules of it. So you guys know what retirement accounts are. So anything from a SEP to a simple to an HSA to a 401k to a solo K. And then in that you have a Roth, which is tax-free growth. You have a traditional, which is tax-deferred growth, where you get a little tax break today instead of later. And self-directed is exactly the same. It's just self-directed allows you to now invest in things like real estate, private lending, Justin's fund, other private funds, intellectual property, businesses. You can invest in almost anything with a self-directed, as opposed to an IRA at like Charles Schwab or Merrill Lynch or with your financial advisor, where your options are the stock market, or the stock market, whether that's in an index fund or a lifestyle fund or individual stocks or bonds or whatever. But it allows you to invest outside of the traditional stock market and traditional investments. So everything that we talk about.
Yeah, CP, there's no charge for us to set up the infinite banking policies. We don't charge anything for that. Stephen, can you put your link up there in case somebody wants to set up a call with you to discuss that? So yeah, we don't charge for any of that. The insurance company pays us a commission. So, and that's what I was mentioning earlier. It requires the way we design them to do what that one looked like that you saw earlier. We reduce our commission on that one. Was that a Slayer design, or that was a Slayer, wasn't it?
Yeah. Yes.
Yeah. So that one, we would have reduced our commission by 65% to make that happen. So usually it's going to be between 60 and 90%, depending on the design. With dump-ins, it's traditionally going to be about 65%. We're going to reduce our commission because otherwise the MEC rules play into it. So we're giving up commission so that you can have more cash value, as you saw. So that's how it works. So because of that, we don't charge anything. There are people in our industry that do. They charge for like coaching. They charge for setting the policy design up or doing what we do for free on the mapping, which is the back end of our business, where we help put together your entire map on what you're going to use the policy. So like, imagine this, like you get your policy and you get a hold of Justin and you decide, all right, I want to take money from my newly created policy and I want to put it into the hedge fund. What our mapping team will do for you is create a 2-year like map of what that will look like. Because you could then take the loan out and they'll calculate the loan interest rate. They'll calculate whatever you want the recapture to be. So maybe you make $5,000 a month, from the fund, and you want to put $2,000 back into your policy. We can map that. And then you just go below $3,000 a month on wild parties in Dubai. To each their own, whatever. It's on my bucket list.
And here's just a quick example. This is a little bit older gentleman, 54 years old, a little bit smaller dump in, $1,000 a month or $12,000 a year. And you can pay in whatever you want, monthly, quarterly, biannual, upfront each year. That's completely up to you. It can change over time. Let's say you get to the 3rd year, financially, something happens to your life. You can't do the 12,000. You could drop that all the way down to about 4,500. The policy will keep growing. It'll remain in force for the rest of your life. So you have a lot of flexibility on this thing, on what you can do with it as well. But even with this lower dump in and lower amount, I mean, you could still see, 56,000 in the first year of that 62, that's 90-some%. I mean, in the 3rd year, they're already in positive territory, cash on cash, and it just grows from there. I mean, they're 65 years old. They put 4,200 into it. It grows by over 12,000. Right at $12,000. So it gets incredible growth. And we can do this whatever amount you want. If you have no dump in, no problem. If you want to do dump in later this year, great. Let's set it up that way. If you want to do monthly, we can design this thing however you want. The only recommendation we would would make is that you would do as like a minimum 10 times your age on a monthly basis. So if you're 42 years old, 420 a month. If you're 55 years old, 550 a month. So that amount or more would be like a good starting point as like a kind of a minimum, so to say. But anything outside of that is completely up to you, and happy to hop on a call. We can talk about it. I know somebody else over in the questions over here a second ago asked, hey, well, there's a lot of options on here. You have Private Money Club, you have Inicio Fund, you have Justin's Hedge Fund, you have all these different opportunities we talk about all the time. So right now, if you want to schedule a call, I'm happy to kind of talk about pros and cons with you. It really boils down to your situation. Do you want monthly income? Are you doing this for long-term growth? Like, what does that look like for you? Where's the money coming from? What's your overall tax picture look like? So we can discuss the pros and cons. And I right now do that every Monday at 1 o'clock Eastern on Money Club Mondays. We'll talk about some of the different types of investments and different types of deals and lending and stuff like that. And we are going to start a new show in the next couple of weeks on Fridays. It'll be a fun one, but it's going to be all about just alternative investments. So things like Justin's hedge fund and Inicio and different things like that, even getting into investing in precious metals. And if you're really crazy, which I'm not, but if you want to, maybe we can even talk a little crypto.
Love it. I really felt like this was just an awesome topic to kick the new year off. I didn't even know, you never told me about these returns. We've been talking about this fund the whole time. I was more interested in the PPM and the subscription agreement, and I gave him so much shit because I'm the idiot, actually maybe you call me the smart guy, that reads every line of a PPM in a subscription agreement, every line. And I had questions after questions, and because I was doing it through my self-directed IRA, I had all these things that I might not be your biggest pain in the ass client so far with getting it set up, but I was probably close, right? You can be honest.
Depends what it is. You got when you're dealing with money, you got people get weird, I've got people that are they log in the portal because it becomes addicting because we update the portal every day. So you have a login as an investor, and it's like the ultimate dopamine hit. How much money did I make today, right? And some days we don't update it till 2 or 3 p.m. Most days it's around noon. By 2 or 3 o'clock, people are texting me, did we trade today? It's
I love it. So, but I guess at the end of the day, it's, you just gotta, I like the details because I understand, the private party memorandums and the subscription agreements, and I'm always trying to learn and trying to get better at this. But it's just so timely with the markets, just all over the place, and soon probably just going to be straight south. They're not going to be going north, and they're not going north now, folks. They're just ping-ponging around. It's the most stressful thing to watch, which is why we don't watch it. We just laugh about it. I mean, even lazy Cash doesn't look at the stock charts anymore. That's all he used to do. He used to sit here, unless he was eating, he just checked out stock charts. He doesn't even turn his computer on anymore. He's just lazy now. I mean, I don't even know why we keep him around here anymore, but he's cute. So for any of you that don't know, if you're new to this is our shop cat. His name is Lazy Cash. Cash meet everybody meet Cash. But for that being said, folks, a lot of really exciting stuff coming for 2023 from our family to your family. Happy New Year, and stay tuned because there's going to be a lot of really awesome stuff. And also just another little thing, I almost forgot to mention this. For any of you that are joining us for the Sold Out Experience Mastermind in Mexico, you're all going to be poolside with Justin because he's going to be there. He's one of our speakers.
Oh, snap. I didn't even know that. Awesome.
Yeah. Oh, snap.
Go.
Yeah. So you're going to get to hang out poolside with Justin and shoot the shit about the hedge fund and everything else. And it's going to be a jolly good old time, or a jolly old time, whatever that was from National Lampoon. Anyway, thanks everybody for joining us for another week of Wealth Webinar. We will see you this afternoon, 4:30 p.m. for the Ask Me Anything, where we answer the rest of your questions. So save them till then. Thanks. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button, actually smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.